Hi, Jim Kniffen here, bringing you the easiest and most effective way to see and understand what's actually going on in the stock market. I'm a certified financial planner, chartered market technician, and certified Kingdom advisor. My work centers on helping individuals and families manage their investments with discipline and clarity and a long-term view for compounding wealth over generations. My goal is to help you compound wealth with wisdom and risk management, bringing you the growth that empowers your life vision, purpose, and impact for you, your family, and your communities. Each week, I break down the stock market through the lens of relative strength. I look at the major indexes, bonds, international, even sectors to see what's really working and what's really not working. This is not just a bunch of numbers, data points, and percentages. I'm bringing you visual simplification, turning market data into actionable insight. I think we all know some of the major forces driving the market these days: artificial intelligence, Federal Reserve interest rate policy, the government shutdown, inflation, tariffs, and some geopolitical military events happening around the world. Now, we can try and understand what impact these forces will have on the market. But really, it's best to just look at the markets and understand what the markets are actually doing. This cuts out your personal biases, your media biases, news that you might be getting that sways your thinking one way or the other. Just look at what the markets are actually doing. Let's take a look at the charts, shall we? Okay, let's dive into the charts. First, let's take a look at the major U.S. indexes. This chart shows the performance of the NASDAQ 100, the Russell 2000, the S&P 500, and the Dow Jones Industrial Average since the beginning of April. I use this date because that's when the market made its turn from that sharp bearish action in early February into April, and really marks the beginning of this current bull run. As we can see, the NASDAQ 100 is outperforming. The Russell has been gaining speed, but the last couple of weeks have been kind of challenging for the Russell 2000 small cap index. The S&P 500 is just chugging along quite nicely, though we did have a little bit of volatility last week. We'll take a closer look at that in just a minute. The Dow Jones Industrial Average is bringing up the rear, but doing so with a little bit less volatility. Here we have the S&P 500 with some trend indicators so you can get a sense of the price movement. When these moving averages are lined up like this, that is a very bullish configuration. When the market is in an uptrend, it's going to be above all of these moving averages. When we're feeling some short-term pressure, it'll come down through the 21-day moving average. It'll even test the 50-day moving average. Last week, it came down, and during the day on Friday, it actually touched the 50-day moving average and then recovered and finished up. This is very bullish action for the S&P 500. The bears want to try and push the market down, but the bulls are clearly in control of the market. Let's take a look at stocks versus bonds. Here you have the major U.S. stock market index, the S&P 500, and the major U.S. aggregate bond index. That is not aggressive bond, that's aggregate bond index. It's intended to give you an overview of the entire bond market. The major allocation question is, how much money should I put in stocks versus bonds? People will put a larger allocation to bonds if they want to be more conservative, and a larger allocation to stocks if they want to be more aggressive. We can see that stocks are significantly outperforming bonds this year. That trend is continuing, and we should be able to see if that trend changes through the use of these charts. Now let's take a look at the international indexes. Here you see the S&P 500 for reference, and the developed markets internationally are just performing right along with the S&P 500, a little bit behind, while we see emerging markets, which would be Mexico and China, largely outperforming in the last 2 or 3 months. If we take a look at The rest of the bond market, we can see that there are several areas of bonds that are performing a little bit better than the aggregate bond index. When I look at the government bond complex, however, interest rates are giving us very low yields and very low performance in the safer bonds, government bonds. Taking a closer look at government bonds, because that scale we were just looking at is so tight, you can see that municipal bonds actually are doing the best out of all of the government bonds in the current environment. One of the key ways I like to look at the market is to compare U.S. growth versus U.S. value stocks. Here we can see that the large cap growth stocks are outperforming the large cap value stocks pretty significantly. That's 52% since April versus roughly 22%. Small caps are outperforming a little bit over the S&P 500, with microcaps giving us the best performance, but microcaps can be a little bit more volatile than the rest of the market. When I look at volatility, I see the high volatility stocks are doing much, much better than the rest of the market, and that the low volatility stocks are doing actually quite poorly this year compared to the rest of the market. While dividend paying stocks are underperforming the market, but at least giving you a little bit smoother ride. This line does include dividends being reinvested, by the way. Let's take a look at the sectors. We can see technology has been just gangbusters, while the rest of the sectors really are either performing right with the S&P 500 or lagging. The consumer discretionary is not really showing any signs of stress. When we look at the sectors that are kind of in the middle, kind of hard to understand whether they're going to outperform or underperform, we see the industrials and communication sector performing with the S&P 500 with a little more volatility. The utility sector has had a pretty good year with a little bit of volatility in the last 6 weeks or so. And last, we see healthcare, which has lagged most of the year, all of a sudden taking a really nice turn up. We'll have to keep an eye on that one. And then looking at the laggards, these are the areas where you would expect money to flow if there's a lot of turbulence expected in the market. They have been lagging behind: energy, financials, materials, the real estate sector, and consumer staples. But we're actually starting to see, especially in energy and materials, a little bit of an upturn that might be of interest. So we'll have to keep our eye on those sectors. And that's a quick overview of the markets. Thanks for joining me for this week's market update. If you find these insights helpful, be sure to like this video and subscribe to our YouTube channel. And if you're watching on LinkedIn, don't forget to like and follow our page for more market updates and financial insights. To take the next step forward with your financial goals, visit our website and schedule a consultation. I'd love to help you build a plan to compound wealth, moving you towards your life vision and purpose. Thanks for watching, and we'll see you next week.